In today's session, we are going to see the various valuation ratios which can be derived to value a specific company within the same industry. For example, if I want to value Colgate-Palmolive, then I would pick up Colgate-Palmolive valuation ratios, derive the valuation ratios, and then compare these valuation ratios with any other company within the same industry segment itself. So let us understand what are these valuation ratios. There are two sets of valuation ratios. One set of valuation ratio is based on the market capitalization, and the other set of valuation ratio is based on the enterprise value of the company. So we all know what is market capitalization and how do we derive the market capitalization of the company. With respect to enterprise value of the company, of course, I have not yet shared the video, but I will be sharing a video very shortly how to derive the enterprise value of the company. So let us see at the different ratios of based on market capitalization of the company. There are three main ratios. First one being the price per share of the company, that is the price per earning, and then the second being the price per book, the PB, and the third being the price per cash of the company. And the enterprise method, here we have again three key ratios. The first being the enterprise value by the EBITDA, the second being the enterprise value by the EBIT, and the third being the enterprise value by free cash flow of the company. So now let us look into each of these ratios and how these are calculated. So price per earning ratio, that is the P of the company. This is calculated by taking the market capitalization of the company and dividing by the net profit of the company. Or in other way, we take the share price and divide it by the earning per share of the company. The second ratio, which is the price per book, that what we do is we take the market capitalization of the company divided by the total shareholders equity, or in other way, take the share price and divide it by the total book value per share of the company. And the third is the price per cash flow of the company. So here what we do, we take the market capitalization again and divide it by the total cash flow of operating activities of the company. So in other way, the same thing can also be calculated by taking the share price and dividing by the cash flow per share of the company. So now that you have understood the three formulas based on the market capitalization, let us look into the other three formulas based on the enterprise value of the company. So the first formula is enterprise value divided by EBITDA. It is very clearly stated anyway. So we take the enterprise value and divide it by the EBITDA of the company. We have seen in our previous videos in our profit and loss ratios how to calculate the EBITDA of the company. And then we have the second ratio, which is our enterprise value divided by the EBIT of the company. And the third, enterprise value divided by the free cash flow of the company. So the only unknowns in this session is the enterprise value. How do we calculate the enterprise value? And then how do we calculate the free cash flow of the company? So let us quickly see how do we calculate the enterprise value. So the enterprise value indicates if today I have to buy this company, what is the amount as an investor or the second owner, proud owner, if I have to buy as a company, going to be the next single owner, then what is the amount I need to put to buy? So here I would have to check what is the market capitalization of the company, and then we add to this all the debts, the financial obligations the company is having, because I'll have to pay the debt, because I'm buying the company means I have to pay for the debt as well. And then I will adjust this with all the cash and cash equivalents which the company might have. So by adjusting all these three values, I will get the enterprise value of the company, that is the amount which I can put to buy the specific company. And then of course the free cash flow is our next one which we need to understand. So in order to calculate the free cash flow, what we do is we take the operating cash flow of the company by looking into the cash flow statement, and then we subtract the purchases done towards plant, equipment and all other fixed assets, or even the capital which might be invested as work in progress towards generation of these fixed assets. These also have to be considered towards with a basically a capital expenditure. This has to be adjusted against the operating cash flow of the company to get us the free cash flow of the company. So now that we know all the values and how to calculate, so please feel free, in case you have difficulty in calculating these values and understanding how to use these values to determine your great companies, please put in the comment section or please drop me an email and I'll be glad to help you out. So please subscribe. So I will be sharing many more valuation approaches. Please subscribe so that you will gain immensely from all the videos. Guaranteed guys, I will make investing simple for you that will blow your mind. See you. Bye.